Today's big number, $20 billion. Nvidia is looking to raise at least that in its first bond sale since 2021, according to sources. 7 tranches, maturities from 2 to 30 years. The proceeds will be used for general corporate purposes, including refinancing existing debt, as Nvidia joins other AI leaders like Amazon and Alphabet in raising large amounts of capital to fund AI-related infrastructure. But why does a company so flush with cash need to borrow more? Bloomberg Intelligence reckons that it's to focus on funding partners. BI senior credit analyst Robert Schiffman joins us now. When you publish the React, that's the bit that jumped out of me off the page, right? Why would they do that? Well, they have a track record of investing in the kinds of startups that rely on their technology. Extrapolate on that thesis.
Yeah, well, listen, you can never be too rich. It's a good problem to have. Quite frankly, Nvidia does have a cash problem. They have too much of it. So people are scratching their heads this morning thinking, why are they raising more? Listen, you take money down when it's available. There is so much money chasing after this AI build out. They're going to put in the highest quality names that they can. And I think Nvidia is just taking opportunity here to basically borrow at effectively a zero rate, at least from a WACC perspective, to give them more financial flexibility. I think they're likely to pour money probably back into strategic partners like OpenAI, like Anthropic. And who knows, maybe a SpaceX, which is likely to do their own bond deal, might come to Nvidia for some financing down the line as well.
There's like the smart cost of capital angle to this. The shareholder return story has changed recently with Nvidia. You know, I'm a student of your work, right? It's not that unusual for companies flush with cash to just say like, okay, this is an interesting thing for the finance org or the treasury team to do. Explain the kind of nitty gritty of that.
Well, listen, you know, the weighted average cost of capital is what they're looking at. The weighted average cost of debt when you have a $5 trillion equity market cap is basically zero. So you could take money, borrow it from bondholders and use it for equity or equity-style investments at a little or no cost. I think you're going to see more of this. You saw a lot of this from Apple over the years.
That's the case study.
We're not used to it now, though, because most of these other companies have now turned free cash flow negative, and they need it for funding for their AI investments. That's not what Nvidia needs. Nvidia is probably going to generate a couple $100 billion of free cash flow over the next year. So they're swimming in the money. But again, when people are willing to give it away for next to nothing, you're going to take it, and you're going to give yourself that financial flexibility.
Robert Schiffman, who leads our credit research at Bloomberg Intelligence, thank you so much.